Welcome to the Capital Spreads Weekly Update. Today is Thursday, the 10th of November 2011, and it's been another volatile few days for the markets. The turmoil within the Eurozone, the crisis is escalating with when we thought we were going to see a Greek referendum, the Eurozone put an end to that, and so the Greek Prime Minister resigned. Now, of course, the Italian Prime Minister Berlusconi has resigned, and the highlight of this week obviously has been the big spike in bond yields for Italian government debt, which of course is very, very worrying. We've seen the 10-year government bond yield spike above 7%. Now that's the sort of level that a lot of people have been saying this is where Portugal, Greece and Ireland, when their government bond yields peaked above 7%, they then went for bailouts. So there's concern in the marketplace that now Italy very much is on the radar, and it could possibly get to the stage whereby it may very easily require a bailout. This is what is causing serious nervousness amongst investors. But what we have seen from the FTSE is, apart from falling very sharply so far this week, once again it has seemed to have found that little bit of support around 5,400, and it's bounced off exactly the same level that we showed you last week. So I've got the same chart, well, it looks like the same chart, but it's not the same chart, it's a week on. And once again, we were calling the market to open a lot lower this morning, but it has done quite well to recover. So 5,400 seems to be that very, very important support level for the index. So that is crucial. So obviously that's roughly where the FTSE is trading at the moment. The Dow is 11,830. Euro dollar has, obviously the euro has taken a real hit in the last few days. Euro dollar down, it's at 135.70. Cable has managed to hold up pretty well. Sterling doing well against the euro, but cable's at 159.20. And gold also has benefited slightly from the turmoil. It has reached as high as 1,800 but retraced a little bit from there, a bit of profit taking. So gold's around 1760 at the moment, and for oil again also a lot of volatility in Brent this morning is around 112.70. So how are clients trading at the moment? Well, not huge positions at the moment, but tentatively long the FTSE and tentatively long the DAX following the recent weakness. But conversely, when you look at US indices, they're short the Dow and short the S&P, but as I say, not particularly big positions. As regards the euro, very much still bearish of the euro. They feel that usually clients go against the trend in FX markets, but it would seem that this weakness in the euro is attracting more sellers. And on the whole, so they're short the euro and long the dollar. As ever, they found that this little retracement in gold has given them a buying opportunity, so they're long gold and short oil. For the rest of this week, it's relatively quiet, really. We've got the Bank of England rate today. That's expected to see little action whatsoever. And then tomorrow, University of Michigan confidence numbers from the US should possibly provide a little bit of action for us towards the end of the week. So the theme this week, well, it has to be the Eurozone and the ECB in particular. We've now got a bond market pointing its sights at Italy, and this is a crucial stage for the Eurozone. What will the ECB do? Will it use its massive firepower and buy up lots of Italian debt, continue to do that, but also will it use any other potential ammunition that it has at its ready? It can possibly print more money, even do some quantitative easing of its own. And the little bounce we're seeing in the markets today is due to there being a bit of optimism that the ECB might make an announcement very, very soon where they may even say we're going to introduce a euro bond. And that of course is what a lot of the investors are hoping for now. It's time for the ECB to step in, but will this happen? That's the big question. We'll have to wait and see. That's it as ever this week. Do give us feedback, media@capitalspreads.com.